Now, I don't want you to think I'm trying to scare you, but the global economy is on the verge of meltdown and currencies are on the verge of collapsing. However, the silver lining is people eventually are going to be forced to use crypto. Not just people, banks, institutions, governments, you name it. In this video, I'm going to break down why currencies are on the verge of collapse. I'm going to show you proof. And I'm going to show you how things are already lining up for Bitcoin to come steal the show. And what's good for Bitcoin is good for the rest of the crypto market, as Bitcoin is the gateway drug into crypto. So first things first, this is a picture of currencies in comparison to the US dollar. You got the Canadian dollar, the Australian dollar, euro, the Great British pound, the Japanese yen. As you can see, they're all trending downward while the US dollar is currently trending upward. And people in the US might be thinking like, oh yeah, that's good. It's good for now, but I'm about to show you why it may not be good here coming up soon. Here's another picture of, showing the yen, the euro, the digital yuan, and the Great British pound versus the US dollar. And the significance of these four currencies is very high, and I'm going to show you why right now. But first, let's take a look at the Great British pound. So this is the monthly chart, the Great British pound versus the US dollar. Whichever one is first, if that one's going up, it's outperforming the second one. If it's going down, it's underperforming the second one. So as you can see, this is the monthly chart. Every candle is a month. The Great British pound is at a level versus the US dollar that it hasn't been to since 1985, okay? It's trending downwards. And the Bank of England has actually responded to this. So they took emergency action on Wednesday, unleashing a £65 billion bond buying program aimed at stemming pretty much to lift up the currencies. It's only two options that you can do. You can either print money to help raise up the currency, or you can pull from your country's reserves if you have any. They decided to kick the can down the road and print more money to prop up their currency. And they pledged to buy $5 billion a day for the next 13 weeks. The crazy thing is, they're doing this so suddenly because they have pension funds that are literally on the verge of insolvency. So the blue collar workers in their country who've been working for their whole lives and ready to save for retirement, they're on the verge of losing everything because these pension funds are levered up to their necks when they're supposed to be taking conservative risks. They're getting greedy and they're not punished for their performance. So they don't care. They're just trying to make as much money as they can. So they're basically resuming quantitative easing to bail out the pension funds that's over leveraged themselves and were facing margin calls that could have literally happened at any time. So now let's go over this chart. This is the percentage share of the global economy. So the United States makes up the largest share of the global economy and 23.9%. China is 18.45%. Japan is 5.1%. Germany 4.3%. The UK, which is England that we just went over, is 3.2%. So we're seeing the smallest domino fall already. So now that we looked at this, let's take a look at this next picture. These countries that I just went over are the major foreign holders of U.S. Treasury securities as of May 22. And U.S. Treasuries is essentially U.S. dollars, but government bonds. So you have Japan with most of the treasuries, and I'm about to go into what Japan's doing right now. China, second, UK, and then Switzerland, Cayman Islands, Luxembourg, etc., etc. So here we are at the Japanese yen versus the US dollar. And the Japanese yen, in comparison to the US dollar, is at levels unseen since 1998. So if we take a look here, Japan is conducting a yen buying intervention for the first time in 24 years. So like I said in the beginning of the video, there's two ways to get yourself out of a situation like this. You can either print more money, or you can dip into your country's reserves to try to prop up your currency. So what they're doing is they're selling their US debt. So let's look at this. The Bank of Japan, ordered by the Finance Ministry, is believed to have sold dollar-denominated assets it holds, such as US Treasuries, to buy the yen in the financial market, investors said. I just showed you guys that Japan is the largest holder of US debt. So I'm going to let you guys in on a little secret, or it may not be a secret, but my favorite finance book is a book by Ray Dalio called Principles for Navigating Big Debt Crisis. It's a textbook about this thick, about that long, that high. And inside the book, he outlined but most of the currency collapse, in the modern age, even going back to some of the old dynasties in China. And the silver lining in currency collapses is there's never been a currency collapse with a world reserve currency, because the central bank can essentially print more money to pay off the debt, and it devalues the level of the debt. If your debt is foreign, your central bank, like for example, let's say, England, their currency is about to collapse. They can't print more US dollars. They can only print more of the pound. So if they owe the United States, they have to somehow either have US dollars to pay them, or increase GDP, or like somehow make money to pay it. And this is why I didn't think I would see the US dollar collapse in my lifetime, but now I'm not so sure, because its world reserve currency status is essentially going away little by little. Like, we're seeing the decline of the US. It used to be that you had to buy oil with the United States, but with sanctions on Russia, and now they're accepting the Russian ruble and Bitcoin. I don't know if it's legal or illegal. They keep going back and forth for oil. China's paying with the digital yuan, I believe. So, if I'm a country that's buying oil and I know I can pay with other things, I may not hold the US dollar, or not have as much incentive to. Also, currencies are based on supply and demand, just like any other market. Currency is a market as well. It's a currency market. So if a bunch of people is holding your currency, okay, that's good, because it's a shorter supply and you can have an increase in demand bidding for that currency. But if everyone sells it, like we just saw Japan, they're selling, or believed to have sold, some of their US debt. So now that makes the US dollar more abundant. And if less people are bidding on it, the value of it is going to go down as well, making it not a reserve currency, because people aren't saving on it. They're more worried about their own currencies, as they should be. So if we look here, we saw that the Britain, Japan, Europe, and China are the biggest holders of United States debt. All of their currencies are collapsing. And, who's to say that all of them are going to just print more money and kick the can down the road? Eventually, they're going to have to do something. So eventually, they're going to have to sell off their U.S. debt, unless they care more about the U.S. surviving versus their own currency. And we all know that the whole economy runs on incentives. And now let's look at the yuan. You see the yuan dropping like a rock as well. So it's like, while the US dollar is doing good now, all of these countries whose currencies are on the verge of collapsing, they're all holding a very large amount of US debt. And we don't know if they're all going to print money or sell the debt. I would anticipate some of them are going to sell the debt. On top of that, we have Credit Suisse on the verge of collapse. It's one of the largest investment banks in the world. Right now, their credit default spreads is at a 14-year high. And a credit default swap is basically an agreement to exchange future cash flows. Typically, one cash flow is based on a variable rate or floating price, and the other is a fixed one. So to give you an example, let's say I'm an investor and I go buy a government bond. And let's say it's a risky bond, and they're paying me a 12% coupon rate, interest rate, and it's a 5-year term. Now, if I'm thinking to myself like, ooh, I don't know if they're going to be able to pay me back this in 5 years, I'm going to take a small amount of money, go to an insurance company or a Credit Suisse, and take out a credit default swap that says, hey, pay me this fixed amount, so that way if this company defaults, I can still get paid. The problem is these institutions, Credit Suisse, same thing happened with Lehman Brothers. They were doing the same thing. AIG, they didn't have the money once all of these companies started to default. And we know that the Federal Reserve is constantly raising rates. So the more that they're raising rates, the more expensive debt is going to become, which is going to increase the risk of default, which is going to make these people who took out these credit default swaps to come back to companies like Credit Suisse, just like they did with Bear Stearns and Lehman Brothers. These Credit Suisses leverage up to their neck. They have over $1 trillion in leverage. Not only that, in the past 7 quarters, they've only been profitable once or twice. And to throw the icing on the cake, they've lost $9.3 billion in an investment and $5.5 billion in an investment, loaning money to Greensill Bank and Archegos, if I'm pronouncing that correctly. So let's go through a little bit of this thread here by Graham Stephan. So we see that the credit default spread is at a 14-year high. That means risk is increasing, like the risk of default is increasing. So we have another rate raise probably coming up here in November, and someone's going to be on the verge of default, and when they come in to call the swaps, and they've been losing out money, their stock is down 60% just this year. If they collapse, so many firms have exposure to them, and they're a much bigger company than Lehman Brothers was. So the collapse will be way worse. Like Chamath Palihapitiya was saying that, oh, I think we're getting to the bottom of the bear market. Chamath, if you're watching this, you are big wilding, my friend. We have never seen a market bottom while the Federal Reserve is in the middle of raising rates. Interest rates or inflation is still at 8%. The goal is 2%. They're going to keep raising rates. I don't care if midterms are coming up. We are not at the bottom 100%. Well, you can never say 100%. 99.9999%. So hopefully all this makes sense. So now I said at the beginning of the video, investors are going to be forced to use Bitcoin. Now, let's go over why that is. So normally in a time like this, you see gold soar. I've never seen a better environment for gold than right now. Like literally every single metric I look at is arguing for higher gold prices. And it's driven especially by, the world embarking on the greatest round of money printing that we've ever seen. And this trend was already in full swing before 2020. But it just went crazy, after the pandemic happened. They dropped interest rates and they added, over $20 trillion to the economy and to print money. And that means people should be flocking to investments and assets that can protect their wealth against the ravages of inflation. And that's why inflation is so high right now. Like literally for thousands of years, the default choice for protecting wealth was gold. So when things look spooky in the market, investors flock to gold. Even though the U.S. spent trillions of dollars on, COVID relief in the past 2 years, stimulus checks they were giving out, gold hasn't done a thing. So let's look at this gold chart here. If we look at the 2008 financial crisis, look at what gold did. It went on a tear, right? And now we're under financial situations that's worse than this, and gold is dropping. So what is that telling me? It's telling me gold is no longer doing its job. People are no longer turning to it for a store of value like they did for millennia. And gold is withering on the vine despite the most fertile conditions for growth that it's ever seen. There's only one reasonable explanation for what's happening. Gold is finally being replaced by something better, and that something better is Bitcoin. Now, I know all you gold bugs out there, it's going to be hard to accept this, like, place value in a piece of software. Gold has a multi-century long track record. Bitcoin's only been around for 10 years. But I'm going to give you an analogy. People also use horses to get around for thousands of years. Then, in less than a decade, cars rendered horses obsolete, and this is a fact. In 1907, there was 140,300 cars registered in the United States, and only 2,900 trucks. People and goods still traveled long distances on land and railroad, and short distances by foot or horse carriages. 10 years later, in 1917, there had been a 33-fold increase in the number of cars registered to almost 5 million, and a 134-fold increase in the number of commercial, agricultural, and military vehicles to almost 400,000. Horses were now an imperiled minority on the roads. Okay, so it's not hard to imagine that Bitcoin is replacing gold in the very same way. It's like when you break it down, they function similarly and offer many of the same benefits. If you want to understand how Bitcoin works, click the link in the description, and I made a video going over all the fundamentals of Bitcoin. But Bitcoin is more scarce. Gold has a 2% annual inflation rate, which means every 50 years the supply doubles. Bitcoin is becoming more and more scarce. It's durable, it's private, but it's easier to store, it's easier to transport, and it's easier to be exchanged. So that makes gold the horse and Bitcoin the car. So you already have banks and corporations and insurance companies buying Bitcoin, and you have the great wealth transfer that says over the next 25 years, millennials are set to inherit $64 trillion from their parents and grandparents, and our lives are just becoming more increasingly digital. And, another big reason why gold isn't going up is because it's so easy to manipulate. Gold is a defective asset on a non-existing network. Bitcoin is an asset, a network, and a protocol. The asset is capped at 21 million. The protocol allows you to send it anywhere in the world to the other side of the world in a matter of 10 minutes on the most secure network in the world. And the network allows you to sync Bitcoin with some underlying payment gateway like Venmo or PayPal and have them all synchronized with integrity and have all the prices update in real time. There is no way to sync up all of the physical gold and the gold derivatives on some payment gateway. You just can't do it. And also, it's so easy to manipulate gold because since it's so hard to store and no one wants tons of gold in their house, these banks have gold in their vaults and they 100x short it because they know people aren't just going to come and redeem a bunch of gold like they would cash. Okay? And one more thing on the Credit Suisse thing. If we look on the New York Stock Exchange.com, it shows the largest market makers, and Credit Suisse is at the top of the list, right above Deutsche Bank and Goldman Sachs. And if you want to learn about what a market maker is, click my video where I'm showing you how I'm making $1,000 a day by being a market maker within crypto. But essentially, a market maker supplies exchanges with liquidity in the form of trading pairs. So if Credit Suisse goes bankrupt, I'm pretty sure they're going to have to sell the assets they're using to market make. And essentially, market making is like, let's say I want to buy some Tesla stock. They need market makers to buy a large amount of Tesla stock and a large amount of cash and put it on the exchange, because the exchange isn't buying all that stuff because, exchanges just aren't that rich. They have market makers with deep pockets. So now they deposit, like, let's say 100 million in Tesla, 100 million in cash, so that when people buy and sell Tesla, they're filling those buy and sell orders from their inventory, okay? So what I'm saying is, given that Credit Suisse is the largest market maker for the New York Stock Exchange, if they go bankrupt, they're not going to be able to do market making, which means they're going to have to sell that stock. And supply and demand, if there is an increasing supply and the same demand or a lower demand, you have the same amount of people or less people bidding on more goods, which means prices have to go down. So we're not near the bottom, okay? So that's pretty much everything I have to say regarding that. If you want to learn how we are taking advantage of these market conditions and printing money, despite what the market's doing, because we are printing money, market making on decentralized exchanges, click the link in the description to apply to get into our Discord. We're only letting a few people in. Only a few people are going to be in the know. And, I look forward to meeting you. Just because things are dim and grim doesn't mean there's opportunities. There's a quote that says, you never want to let a good tragedy go to waste. So if you got value from this video, I strongly ask you to consider hitting that subscribe button, leave a comment, leave a like, turn on those bell notifications, because these videos are time sensitive. I'm trying to give you the best content in regards to crypto, book reviews, and day analyze. We're trying to inspire. We're trying to help you become the best person you can be. Okay? So with that, I thank you for tuning in. I love all of you, and I'll see you in the next video.